Hey everyone! In this video, I'll try to give you everything you need to understand the logic behind price movement. What I'm going to say in this video applies to absolutely any financial instrument and any asset, because technical and candlestick analysis are the foundation. So let's move on to time frames and trends. Look, here we have a candlestick chart, and if I hide the hourly time frame, hide the dates, and hide the price quotes, and just click on any of the time frames, you won't be able to tell which time frame it is. In other words, the market is a fractal. And again, everything I say in this video works absolutely on all time frames, but there are some nuances. For example, on smaller time frames, there's more noise, but there's certain periods of time that market participants are more interested in. That's what we're going to talk about in this video. So here we have a chart of Bitcoin to the dollar on the 1 hour time frame. The first thing we need to do to start our analysis is to identify the trend. I think that's pretty easy to do. Here, as we can see, the trend is downward, meaning the price is gradually moving down and our highs are getting lower. All right, now let's switch from the 1 hour time frame to the daily time frame. What do we see here? Here, the trend is also downward. Okay, let's move to a smaller time frame, say the 5-minute chart. Here, the trend is also downward. So which time frame should we actually trust? Because sometimes on the 1 hour time frame, the trend is downward, but for example, on the 5-minute time frame, the trend is upward. So you have a downward trend and an upward trend. Which of these trends should we trust? To answer this question, all time frames are interconnected, and it's important to analyze the overall market picture across all time frames. In other words, there aren't any specific rules about which time frame you need to analyze. You need to analyze absolutely everything you see. Sometimes the daily trend is going down, but on the 5-minute time frame, you can open long positions because the trend is upward. Now, regarding which time frames market participants pay the most attention to, first, it's the hourly time frame, and second, the daily time frame. So these are the two main ones. For example, if you trade intraday, you absolutely need to analyze the hourly time frame. If you open positions for a longer period, for several days, you definitely need to analyze the daily time frame. And of course, if you're a long-term investor, you shouldn't forget about the weekly and monthly time frames. They can also tell you a lot and add to your overall picture of the market. The second thing we'll talk about is support and resistance levels, as well as consolidation. All right, we figured out the time frames. Now let's talk about support and resistance levels. This is the second thing you need to do after identifying the trend. Determine the support and resistance levels, of course, the main ones, and those closest to the current price. So I think everyone knows that the support level is below and the resistance level is above. Let's immediately figure out how to actually draw these levels. Naturally, there isn't a strict rule for this either. You can draw levels with lines, for example, or you can mark levels as zones, like this. In both cases, you'll be right. A zone, of course, gives you more information. A level is actually a cluster of orders. Traders don't place their orders at a single exact price, so it's more accurate to mark levels as zones. So how do you draw support and resistance zones? Let's smoothly move on to candlestick analysis. A candlestick has a body and a wick. The body is this thick area right here. The wick is a small line above or below the body. Support and resistance zones are built based on clusters of price bounces in the same area. So the first line should be drawn at the wicks of the candles and the second one at the bodies of the candles. What do we get as a result? So at the top we have the highs and at the bottom we have the main bounces. In other words, most of the reactions happen in the resistance zone. But again, it doesn't really matter how you draw the level. What's important isn't how you draw it, but the fact that it exists, because you won't be able to pinpoint the exact boundaries where the price will bounce anyway. So the name of the support or resistance zone depends on where the price is located on the chart. That is, if the price is here on the chart, this is the support zone. If the price is here again, let's say, then this is a resistance zone. Now the price has broken through the resistance zone, and now for the price, this is the support zone. Whether it's above or below, the price will react to this zone in the same way. Now, let's touch on the topic of trends again. I forgot to mention consolidation. A consolidation range is when the price stays in one place or within a certain range. Here we have a consolidation. That is, the price was moving within a channel from one level to another. When the price makes a trending move, it then goes into consolidation. And after consolidation, we get another trend. And that's basically how market movement works. So you need to be able to determine which phase the market is in, trending or consolidating. Again, it's not that simple. Every consolidation has its own trends. If we open smaller time frames, you'll see there are trending moves within that consolidation. Here you go. We have a trend, consolidation, trend, consolidation, trend, and so on. I think you get the idea. The next topic is candlestick analysis and patterns. I think now you understand why it's important to look at the bigger picture of the market, to take all the nuances into account. So now we're moving on to candles and candlestick analysis. Candles are the most informative indicator available in the market. And you know, right, that there are candlestick patterns, a huge number of them, but you don't have to memorize them all. The main thing is to understand the logic behind how these patterns form and the logic of price movement. Remember this rule. All candles should be viewed in comparison to the size of other candles on the chart. So here's some bearish candles, and you can see that they're small compared to the others. So here are the other candles, and these candles, compared to those, are small in size. That means we look at all the candles in relation to each other on the chart. So a small candle with short wicks indicates uncertain market movement, showing that the bears or bulls are losing strength. So here we see a downward impulse, then the bear's strength gradually fades and small uncertain bearish candles form, which indicate this. Gradually, the chart moves into consolidation and buyers start to take over. Why did buyers start to dominate during this consolidation? Let's now compare the candles within this range. We can see that there are a lot more green candles than red ones, and the green candles themselves are much larger in size than the red ones. This allows us to assume that buyers are dominating in this range. That's the logic behind the pattern. Patterns reflect the market participant's sentiment. Reversal candlestick patterns can indicate both a trend change and a consolidation. If you want to increase the likelihood that the signal will indicate a trend reversal rather than a consolidation, you need to look at the overall market picture and the conditions under which the pattern forms. Patterns can consist of a single candle, 2 candles, 3 candles, or even more candles. For example, technical analysis patterns. Let's say here we have a perfect pattern. This is a head and shoulders pattern. We see the shoulder, the head, and the second shoulder. Here's the neckline, and the neckline has been broken. So we combine all the knowledge we've learned earlier in the lesson and see a trending movement, consolidation, then a breakout from the range, and a break through the resistance level. The resistance level has become a support level. The price came back, bounced off the mirror level, and continued moving up. There are many technical analysis patterns. For example, we see a price movement range, and the range is narrowing. Naturally, when the range narrows, the price always breaks out in one direction or another. At the end of the range, when it has narrowed as much as possible, the price can break out either up or down. All of this is viewed in the context of the overall market picture. It's important to look at the trend, to watch the levels, and to pay attention to candlestick patterns. Again, candlestick patterns can be seen on all time frames, but they work best starting from the 1-hour time frame. So a practical example, market analysis. Let me try to give you an example of what we've just learned. An example, let's take a situation. There's a downtrend, and within that trend, there are smaller trends. For example, here's a downtrend, a small consolidation, and then another downtrend. There was a consolidation here and a breakout of the support level located at this spot. I'll draw the support area right here. Then the price broke through it. At the same time, there was a strong impulsive move downward. Then the price comes back with a strong uptrend. So we're looking at the whole market picture. The overall trend is downward. Here we have support levels that have turned into resistance for us, meaning they're now mirror levels. Here you can consider a move downward. At this point, let's say on the 1-hour time frame, a technical analysis pattern called a double top forms. Let me draw this separately and mark it with an arrow. The trend goes up, forming the first high as a candle with a small upper wick, which suggests a possible decline. After that, the price moved down. Here, it ran into a local support area, bounced off, and then continued upward. Here we have an engulfing pattern forming. So this is a green candle, and this is a red candle. The red candle engulfs the green candle, which lets us assume that the bears have more strength. The price moved down, broke through the technical analysis pattern called a double top, then came back to the broken level, retested it, and continued downward along the trend. These are the main principles in trading that we just gone over together. These are trends, support and resistance levels, the overall market picture, patterns and the logic behind candlestick patterns, market phases, and so on. There's nothing complicated here. These are just general principles that you need to combine and use together. Friends, I'd really appreciate it if you give this video a like if you found it helpful. Share your thoughts, your support, and your feedback in the comments. It's really motivating. Subscribe to the channel and turn on notifications so you don't miss the next helpful videos, which come out every day. Subscribe to the Telegram channel too. All the links will be in the description. There, I share free trading signals, market insights, and a lot of useful information. Wishing everyone big profits. See y'all next time.